You need 20% down to buy a house. Wait, what? No, you don't. Let me explain why. It is part of the American dream to own a home, and many think this dream is dead. Part of the reason for that is this myth that you need 20% down to buy a home. Don't get me wrong, having 20% down can be a great asset in qualifying for, paying off, and affording a home loan. The amount of down payment you have is an important factor in determining the type of loan you get and the terms for that loan. But there are a lot of factors to consider when setting up your home purchase plan. House values, loan repayment, property value, inflation rate, and closing costs. These all take part in the decision. So why do we need to have a down payment? It's not for you, though it does lead to smaller payments, but the lenders require a down payment to reduce their risk. By providing a down payment, you're showing the lender that you have financial discipline, financial stability, and the lender is now better able to recover their investment if the borrower does default on the loan. But there are loan programs that allow for a down payment as low as 3%. And even in some cases, you can get a zero down loan. A quick rundown of the types of loans available is conventional loans. These are offered by private lenders and not backed by the government. They require a down payment between 3 and 20% of the purchase price, require a credit score of 620 or higher, depending on the lender, and may require mortgage insurance or PMI until 20% equity is obtained in the home. Next are FHA loans. These are backed by the Federal Housing Administration. They have a minimum down payment of 3.5% and require a credit score of 580 for that 3.5 down. If you've got between 500 and 579, you're going to need 10% down. Now, these have a mortgage insurance premium of 1.75% upfront and an annual max fee of 0.55% when you have less than 10% down over the life of the loan. VA loans, which are offered only to military veterans, active duty, and surviving spouses, these don't require a down payment and there's no insurance required. However, they do require a funding fee of 1.25 to 3.3% of the loan amount. Now, unlike the PMI, this total amount is tacked on and financed as part of the total loan. Finally, USDA loans. These are income restricted loans. They're location dependent and they're given to low to medium income borrowers. Location restrictions include rural areas with populations of 35,000 or less. There's no down payment required, but they do have a guarantee fee. Now, the upfront maximum is 3.5% and an annual fee of 0.5%. Now, if we can get loans with no money down, why should we ever make a down payment? Down payments serve several specific functions for the home buyer. Your down payment lowers your payment in 3 ways. First, you finance less, so you have less to pay back over the term of the loan. Second, less risk to the finance company can mean lower interest rates. And third, if you do have a funding fee or mortgage insurance, those fees and rates will be lower with the larger down payment. Now, this is where the 20% down has become the conventional suggested down payment. When you reach 20% equity in your property, lenders feel you have enough skin in the game to reduce their risk, and you may not need expensive loans with funding fees or insurance to cover your lender. So let's set the stage for 2 purchase scenarios, one at 5% down and one at 20% down. Now, the average U.S. home price for 2024 is $420,800. So let's use that amount. And we're only going to compare conventional 30-year loans. So first, we've got the Jack scenario. He's going to go with a 20% down payment. He also has all the closing costs, so that he'll start with 20% equity in his home. Now, What interest rate you get is dependent on more than just the down payment. So we're going to use the same interest rate for both scenarios at 5.34%. With 20% down, the benefits Jack is likely to receive are lower monthly payments, no private mortgage insurance or PMI, and less interest paid over the term of the loan. So with $420,800, his down payment is going to be $84,160. Jack is going to be financing $336,640. That will get him a payment of about $1,877.75. Over the term of Jack's loan, he's going to pay $339,349 in interest for a total cost of his house of just over $760,000. In the next scenario, Jill is going to work with a 5% down payment. So Jill has this 5% to put down and all closing costs so that she's going to start with 5% equity in her home. So we're going to use the same interest rate for both scenarios, 5.34%. Some of the benefits that Jill is going to have is that she's going to have lower upfront costs, quicker access to home ownership, and the ability to invest any of those savings elsewhere. So for $420,800 at 5% down, she's going to have $21,040. And she's going to be financing $339,760. Jill is going to have a payment of $2,484 and some change every month. Over the term of her loan, Jill is going to pay $494,781 in interest for a total cost of her house of $915,581. That's a difference of $155,432. That's a significant savings for Jack. But these are scenarios where both Jack and Jill had the down payment and were able to move today on a house. Now let's look at starting from zero and saving a down payment. Jack and Jill are both looking at the same house value again, and they figure they can reduce their current lifestyle to start saving for a down payment. Jack is targeting 24% to cover the down payment and the closing costs, and Jill is targeting 9% for the same reason. Calculating the monthly payment for a $420,000 house, adding in for taxes and insurance, we get an estimated payment of $2,949 a month. Now, both Jack and Jill can afford this amount, but they're going to reduce their standard of living by 20% and find something that they can rent for $2,359. They will be saving $590 per month for their down payment. Jill hits her target of 9%, which is $37,872, after 5 years and 7 months. Jack, however, hits his 24% at $100,992 after 14 years and 4 months. Now, during this time, the housing market doesn't just hold because Jack and Jill are climbing this hill. The housing market in the U.S. increases on average at 4.62% per year. This means that the value of Jill's house when she hits her target is $542,773, and Jack's house is $801,434. Now, Jill, at the time of her goal, has roughly 7% of the value of the house she wants to purchase. With a good credit score and some keen negotiating on the closing costs of this house, and perhaps going down to 3.5% down payment, Jill can buy the house that she's been working so hard for. Jack, on the other hand, after more than 14 years, has only 13% of the house value that he wants to buy. Now, Jack will likely never reach 20% at this rate. Now, he too can decide to go with a lower down payment, but his house value is about $260,000 more than Jill's at the time of purchase. His attempt to be frugal will end up costing him hundreds of thousands of dollars. The idea behind saving a larger down payment is to protect your current income. Now, if Jack and Jill buy the homes as we've outlined, and they each get a 30-year loan, their payments on the loans, exclusive of fees and insurance, taxes, things like that, Jill will be buying the home with 3.5% down, and for her house, she'd be paying $2,921.58 per month. Totals just over $1 million for the total over 30 years. Jack, with 10% down on his house, would be paying just over $4,000 per month, and this totals $1,448,387 for the total over 30 years. And Jack will not have his home paid off for 8 years after Jill. Any benefit that Jack may have received from having a higher down payment, or perhaps having time to increase his income, has been eliminated by raising house prices. Now, these are extreme cases using average prices and rates. There are opportunities to purchase homes that are much lower than the national average. So don't let these scenarios discourage your home buying dreams. An October 2023 article from Forbes magazine listed the lowest average home prices around the country. You can beat the average national home price with the average prices in these states ranging from $120,000 to $233,000. And these are also averages. So you can find lower cost options in these states as well. If you're not tied to a specific location, home ownership can become a lot more affordable. When you are planning your home purchase, be sure to think about how these plans will work out over the time it takes to put them into effect. Start working with a realtor as soon as you start planning. A good realtor will want to build a relationship with you and not just push you to buy something you're not ready for. And ultimately, you can make the decision that's right for you and not just because somebody tells you it's what you should do. Now, if you'd like to continue your financial education, check out this video.